Welcome to Markets Now. Brian Doherty with Total Farm Marketing is joining us, and we did see a mostly higher day in the livestock mixed in the grains. And Brian, let's talk first of all about the grains, because we really did see some influence today from outside markets, including the pullback in the dollar and the higher energy sector, didn't we?
Well, we did, and those influences had higher values in particular, corn, wheat, and beet across the board. They gave that up a little bit toward the end. And again, I think it's a trader's market. All three are trader's markets. And what do I mean by that? We're at a time of the year where you generally don't have enough sustained, let's say, bullish news. You have to feed the bull. The bears try to sell, but the market will buy the dips, and that's what we're seeing this year. So on a day like today, you get a nice upsurge, but you don't get follow through, and the traders start to sell the market. That's really still a victory for the bullish outlook, in particular corn, where you haven't had a lot of friendly news as of late, and yet we're trading at the same price we were 6 weeks ago. That's a typical kind of base build you hope that when you see in fall is forming the low. And I got to think that as we get corn supply buttoned up in storage, it's going to take something to get it out. It's going to have to be better basis, higher prices, or both, or enough time has to go by. But right now, it sure looks like the market's holding well, despite a lack of real positive. We had USDA reports that were positive, but nothing really beyond that.
Although I will point out that you mentioned cash basis levels being strong, and even though exports may be behind where we were a year ago, domestic demand has been very good, hasn't it?
Well, domestic demand has been very good. Big part of that is as dry as it is, in particular in cattle country, go down to Oklahoma, anywhere out west, there just isn't the fall pasture conditions. And the winter wheat planting's ahead of schedule, but the emergence is behind. Again, reflective of generally dry conditions. If you don't have good emergence of winter wheat, those cattle are going into the feedlot. So, and we saw the USDA bump up that feed usage a little bit, which was a bit of a surprise on the last USDA report. Overall, though, good supplies long term.
Soybeans, again, we check out the top end of the trading range here. It seems like we kind of get pushed by at least some thoughts we're going to get better demand. And of course, we take turns with meal and oil kind of pushing this market too, don't we?
We do. The biggest concern yet is just what China is going to do and if they're going to step in and buy or not buy. And they extracted beans out of Argentina, so that's sort of filled a void. We don't think Brazil has many beans to, let's say, put into the marketplace, so they got to come from the U.S. Then we have this Mississippi problem where we don't know how many beans can get down to the south. We're hearing a lot of talk about China buying some Pacific Northwest beans out of that part of the country, but how much can we rail? Then a potential rail strike. There's just a lot of things in flux. So the beans can't quite get the bullish traction we think we should see at this length into the harvest. We're probably closing in on 90% done. But we need to see that export market sustain itself. The export sales to date have been good, but they haven't been good enough to propel a market at this price for this time of year, because most of those sales came early on in the year.
So we get this tug of war in all three sectors, corn, soybeans, and wheat. So we've been effectively trading sideways range bound. We keep kind of almost coiling a little bit. At what point do we pop out of those ranges, do you think?
Well, that's a good question. So let's start with the wheat market. We've had this nice chart formation, inverted head and shoulders upside. A lot of arrows pointed toward $10 in Chicago wheat, and then we kind of tailed off here. Now we're struggling around $8.50. I got to think we're compressing the springboard, and we're going to spring out of this. What it'll take is probably continued decline in the dollar and some good export sale activity to confirm that, and then get the money flow back into wheat. It's still high priced historically, just as corn or beans are. Same thing with those markets. We need to see these export sales robustly pick up to just get the trade. When I say the trade, the managed money, others who want to buy on strength, not buy the dips. So we need to see the buying on strength and push it through farmer selling on the initial wave of farmer selling.
Yeah, and soybeans, like you said, we need some more of that China demand. So hopefully that, or a South American weather issue, right?
Yeah, and it's a little early for that. You can talk La Nina and weather all you want, but it really isn't affecting the crop. We saw some rains in Argentina this week, maybe a little damper on beans, maybe some in Brazil. Brazil's off to a decent start, though. I think the weather market we acknowledge it, but the weather market really starts about mid-December. That's where the rubber hits the road. It all counts in, and that's really when the La Nina pattern last year really started to surface and extract yield out of the bean crop.
We'll keep our eyes on that. Meanwhile, Cattle market up today for the most part, although we're under the contract highs. So are we going to continue to kind of consolidate in live cattle under those areas or not?
I think we consolidate. I think we still have a chance to take the highs out.
Okay.
When you look at, the consumer all of a sudden is a little bit more relieved, and maybe it's election related, who knows? But the stock market's jumped about 3,000 points in a few weeks. Nice double bottom on that chart. Maybe some money flowing to equities, and gas prices manageable. Not certainly like they were in early when we're talking, $5 a gallon gas. So where I'm going with this is I think the consumer is still going to be full steam ahead with beef and products. If they're going to cut back anywhere, they may cut back on sort of bigger ticket items as they kind of are careful of what this economy looks like and maybe what the election will show.
Yeah, and of course we have boxes moving higher, and the cash trade has been continuing to push that market. That certainly helps. And speaking of cash, wow, the cash market's really been pushing the hogs. Is that going to continue?
Well, I guess the question is, why wouldn't it continue? Hog population down 1%, cash index prices well above the futures, still holding a nice $5-6 premium. Why wouldn't we expect to continue to see money flow into the hog market? It got beat up. We've talked about this before. As soon as China announced that they were removing some internal supplies, hog prices quickly fell apart. A lot of stop orders triggered. That market has since recovered all of that and then some, and continuously reflective of what the hog producer is facing: high input costs, and the idea that you don't have the labor, the whole supply chain there to expand the herd significantly isn't in place. So I think you have a limited amount of supply, and if demand is there, the market holds or moves higher.
Okay. Always appreciate your analysis. Thanks for joining us,
Thank you.
Brian Doherty with Total Farm Marketing.